Hi there. Welcome back to yet another episode of E.M.I. This is the E.M.I for the month of May 2026. So let's jump right in. In this month's E.M.I, as usual, we ask a few questions and make some observations. Why did the equity returns of MSCI India and MSCI US diverge again since March? We notice that gold imports remained elevated. ECB flows picked up, margins could get squeezed a bit. Energy prices surged, pushed up food prices, and weighed down Indian equities. We take a quick peek into global domestic returns, flows, returns related to market cap to GDP, and much more. On investing, we see if a monthly 10,000 rupee SIP can touch rupees 1 crore by the time you retire. And we also see what must be your exact monthly SIP to touch rupees 1 crore by 60 years of age. As tariff pressures eased, Middle East concerns triggered another divergence. US India equity returns diverged again. For more than a few decades now, US and India returns have directionally tagged each other with periods of divergence not lasting more than a couple of quarters. 2025 saw this elongated period of divergence between US and India equity returns. MSCI India returns were seen bottoming out around September 2025 with US returns at arm's length when the Middle East conflict began. We stressed in our earlier two presentations on the peculiar nature of the ongoing conflict. Asian emerging market economies are seen particularly impacted due to their levels of imported energy dependence from the Strait of Hormuz. And therefore, as the underlying uncertainty subsides into the months ahead, India and US returns are likely to begin converging once again. Now let's take a quick look at how some key short frequency macro indicators looked like. GST collection growth saw moderation on higher refunds and muted domestic activity. Total e-way bill growth witnessed normalization after a festive surge last year. Gold imports have been trending down but remain elevated for comfort. External commercial borrowings saw a moderate pickup, a marginal rupee positive. Wholesale inflation rebounded faster than retail, squeezing the margin gap. Fresh loans appear to have transmitted a large share of the RBI's repo cuts this cycle. Credit risk perception improved on the absence of credit risk events and ample liquidity. Brent crude prices remain elevated after shifting upwards post the Strait of Hormuz conflict. Global energy prices surged, and this has translated into rising global food prices. Nifty 50 index continues to feel the pressure from the fallout of the Middle East crisis. Let us now shift to the markets. Before we look at returns and valuations, let's see how the Nifty performed in April. The Nifty witnessed an appreciable rebound of 7.5%, with the small cap index at 17.5 and mid cap index at 12.9% respectively, largely on the US-Iran ceasefire agreement. On a 12-month basis, South Korea returns eclipse that of other emerging markets and developed markets. MSCI India USD is holding up well above emerging market Asia, EU and emerging market indices. FIIs see continued outflows while DIIs see inflows. Realty, energy, media are the top outperformers in April. India valuations are well above peers, just under Japan and the United States. Large, mid, small cap valuations inch up, and large cap is still below long-term average. Market cap to GDP as a measure of future returns. How can we look at that? This chart shows market cap to GDP and plots it along with BSE 500 CAGR 5 years ahead. This underlines the need for short-term investors to increasingly consider portfolio diversification. Now we come to the last segment of E.M.I. What must you know before investing? Can a monthly 10,000 rupee SIP touch rupees 1 crore by the time you retire? In our April E.M.I, we saw how a 10,000 rupee monthly SIP at 12% XIRR could touch rupees 1 crore in 18 years. If you needed this rupees 1 crore by your retirement, by when should you start your SIP? For example, a 20-year-old young investor with a 10,000 monthly SIP would touch 9.25 crores by the time he hit the retirement age of 60 years. However, if one were to start the same 10,000 SIP at the age of 40, the portfolio would be unable to reach rupees 1 crore by the retirement age of 60 years. To touch rupees 1 crore by 60 years, what must be your exact monthly SIP? To reach rupees 1 crore by the age of 60 years, the investor must adjust his monthly SIP according to his age and number of years to retirement. A 20-year investor needs a monthly SIP of only rupees 850. You heard that right? To reach a corpus of rupees 1 crore when he touches 60 years of age. The 40-year investor would therefore need to increase his monthly SIP to a little over 10,000 to reach rupees 1 crore when he touches 60 years of age. Similarly, a 50-year investor with another 10 years to retirement would need to increase his monthly SIP to just over 43,000 to touch rupees 1 crore while retiring at 60. Till next time, this is Arjun signing off.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.